Investing can often feel like a roller coaster, with the value of stock investments rising and falling sharply based on breaking news and geopolitical events. Certainly, the last few months may have felt bumpy. From the build-up to the UK general election in December, to the tit-for-tat missile volleys between the US and Iran, to the outbreak of the coronavirus, it's understandable if investors feel a little shaken. During moments such as these, investors often move their money into safe haven assets, investments that can weather whatever is affecting global markets. The most traditional safe haven is gold, which is still proving widely popular. Gold is widely viewed as a port in a storm, with many investors dedicating a small portion of their portfolio to the precious metal to hedge against uncertainty in the world economy, explains Dzmitry Lipski, head of funds research at Interactive Investor.24. The value of gold has rallied in recent months, from a low of $1,450.41 per ounce in November, hitting a peak of $1,611.25 in early January. Gold is currently trading around the $1,587 level, up nearly 9% over the last 3 months. But why? Despite recent geopolitical uncertainty, global stock markets are also trading around record highs, so what has driven the price of the precious metal? Gold's price surge since mid-2019 has been driven by the plunge in bond yields, with bullion joining the deflation trade into major government debt and so-called safe haven currencies like the Swiss franc and Japanese yen, explains Adrian Ash, director of research at bullionvault.com. Because gold pays no interest, but also can't go bust or be created at will, bullion prices are very sensitive to changes in bond yields, most especially after you account for inflation. With government bond yields at record lows, and in some cases negative, gold has become comparatively more attractive. Looking ahead, gold's price is likely to continue to climb. Analysts predict that the commodity's value will rise by 12% in dollar terms by the end of the year due to investors and central banks adding to their gold positions as a way of spreading risks. Last year, gold gave its best showing since 2011, adds Ash. Consensus forecasts for 2020 see another year of solid gains thanks to the outlook for weak economic growth, low interest rates, a possible turn in the stock market, plus continued geopolitical uncertainty. However, not everyone is a fan of gold. Edward Park, Deputy Chief Investment Officer at Brooks Macdonald, says his company is cautious towards gold at the moment. We believe the price of the metal has become disconnected with the total stock of negative yielding debt which has been a reliable predictor of prices in the past, he explains. We do not have a strategic allocation to gold, as its fair price is notoriously hard to determine. For more on this story, visit the news article link.